Hi everybody, we're going to take a look at one of our new quick applications that we just released over the weekend of March 16th and 17th. We want to give you a little bit of an overview of how this works, and this will be available in the store, in the Quick Apps store shortly. So here you see we're on our landing page for the Quick Apps tool set. Spread Builder, we've talked about that. This week in Futures Options report, and here we go, Quick Options Education. This tool is meant to give those that are new to options or need a refresher for options, or are futures traders that are looking to learn options. This is the place to go. So the idea behind this tool is to give everybody a chance to sort of play with things to see how prices change when futures volatility or days to expiration is changed as part of the pricing equation, and then how Greeks change at the same time. So you'll notice over here there's a pricing section and then a Greek section. So what we've tried to do is show you graphically what happens to a price and or a Greek when a particular input to the options equation changes. So for instance, right, we have the strike, the interest rate, right, which aren't showing here, but the strikes are showing down here. Interest rate is a very minimal effect on pricing unless you go from a really low to a really high or vice versa. But since rates in our generation has been more or less generally stable, you don't have to worry too much about seeing. That's called rho. Rho is what the effect of interest rates have on pricing. So it is there, but it's not anything that we really want to worry about as part of your kind of day-to-day options trading. So we talked about strike, we said interest rate, and then the rest of them that remain, the other three of the five, are the futures price, the volatility, and the days to expiration. So we're going to take a look and see what happens to puts and calls when we change futures vol and days. And from there, we can go through the different tabs. These tabs are just sort of detail tabs of the prices, and I'll explain this in a minute how the chart's represented. And then the Greeks are going to be the Greeks associated with each of the strikes based on the current inputs that we're showing up here in what we call the analysis bar. So right now, you'll notice we're in the WTI contract looking at the May 2019 expiration, and we can go to any expiration that's available in QuikStrike and play with the future, the volatility, and the days to expiration. So you really can. You have a tool here that you can use for a lot of different things. We can also switch products. So any product that we have available in QuikStrike is available to you. If you want to get your education in corn, you can switch over to corn. We're going to stick to WTI here because it's got a nice strike range for a short dated expiration. So it'll be interesting for us to see all the different changes that occur when we start making the changes in the analysis bar. So what is this chart telling us right now? So we look at the legend, we get some immediate idea what we're looking at. So the puts are in orange or yellow depending on what your screen is blasting out to you. Calls are in blue. Current volatility and the current future. So here we have the current future corresponds up here to 58.74. Current volatility over here is going to correspond to 24.11. You'll see if I go across here, it's 24.11. And then the days to expiration. It's not represented anywhere on here, but this is where we're going to see it. Now, as we make these changes, we're going to see a little box that pops up over here that tell us how much different we are than our original analysis, so we can sort of get a baseline and keep track of, hey, this amount of futures movement, this amount of vol, this amount of days. What I do recommend is that you start with one element of it at a time, because that's going to let you really see how much the futures movement is going to affect the price of the put and the call. Then you can change the vol, then you can change the days of expiration. Then you can start to mix them up. But when you mix them up, you're not necessarily going to see the specifics of what each one does to the price or to the Greek. So I recommend that you start one at a time, and that's what I'm going to do here as well. And I'll go through as much as I can as part of this video, but as you play around, you get a little bit more out of it by playing around with it. So let's take a look. I'm going to change this future price. We'll go up to 59.5, and I'm going to hit enter. I'm going to leave the focus of this text box, and then that will recalculate everything. So the future went higher, so we would expect our calls to go higher and our puts to go lower. So when I lose focus, I'm going to see this recalculate, and now you'll notice our bars changed a little bit of color, but how do we read this? So we notice we went up in futures, so our call price went up. So what happens is we're still going to show our dark colors. That's going to be what our new value is for each in the call and the put. So you notice the call went from here to here with that 76-cent change in the futures price. The put went from here to here. So the dark section of the bar tells you what the current value is, and the light section of the bar tells you where we were. So in the case of the put, we were higher and we went lower. In the case of the call, we were lower and we went higher. So a future going up is going to affect the price of the call. We're going to increase, and the price of the puts are going to decrease. Generally speaking, if no other inputs change, right, we could have the volatility increase, which would cause this difference to contract or expand, but that's for you to experiment with as you playing around with it a little bit more. So now we were up 76, so now let's go down to $58, okay, and I hit enter, and now we're going to see an opposite effect here where our call value was up here, it went down here, and our puts were here, and so our puts went up when the futures went down, as we would expect. Puts get, from a definition standpoint, puts get more expensive. If the futures go down, calls get less expensive. So we could see right away what happened when we move the future up and down. So we're getting a nice graphical representation of how premium is affected as the futures price moves. Now, this little arrow over here, if I click on that, it's going to reset this to where we started. Now let's take a look at volatility. Increased volatility should increase all of our option prices. So let's take a look. Let's go up to 25 and see what happens. So now what we should see, we're going to see a little candle on everything. Basically everything got a little bit more expensive. It was here and it went there. It was here and it went there for both the calls and the puts. So volatility increases the value of our options. All right, so now let's go the other direction. Let's go down to 23, hit enter, and we're going to see that all of our premium puts and calls decrease. So we were here and we came down to here. So increase vol increases our prices, decrease in vol decreases our prices. Again, with everything else staying the same. And you'll notice that this is showing where the volatility was versus or the original vol and where it is right now. So the dashed is the original and the current vol is going to show you the solid line. And what I did not mention, and I'll go over here really quickly, so you can see that as well, is if I jump this thing up to 59, okay, you're going to notice that we're going to get the same, we're going to show a difference between the original future and the current future. So any changes you make are going to be represented by these bars, so by the vol chart, as well as by the futures price line. Now the days to expiration, the only place that's going to show is over here. So now let's reset this. And now what do we expect? We expect as time moves forward, our prices to lose some value. So let's go down to 25 and we should see that we went from a higher price to a lower price. So that's time decay. So we're seeing decay real time here in that we see across the board, all the prices lose value. And you'll notice that closer to the money, or at the monies or around the monies, they're going to lose more premium than if we go out. So our theta or our decay is greater around here than it is on the wings, the calls that are further away from the current futures price. Okay, so let's clear that out. And now, even though May is 31 days to expiration, we could say, well, what did it look like, when it was 40 days to expiration, given that the future and the volatility haven't changed, we see that the prices are higher. So more time adds to the premium, less time takes away from the premium. So that's a real nice way for you to experiment, play around with it, and see what happens. Now, here's another one that you can try. So I'm going to move forward. Let's say I'm going to decay this down to 25 days. Okay, so I'm losing some premium here, but now I'm going to say, you know what? I'm going to bump this thing up to 26.5 vol. So you're going to notice I lose money going forward, but my volatility went up, and look, I almost filled my gap. So you can start to play around here and say, well, how much vol do I have to increase right now in order to cover my decay? So it's a nice way for you to kind of figure out what needs to happen from a movement standpoint in order for you to recover your decay. All right, so let's reset this. And now, so that's the prices. So what do we see here? We have puts on the downside, calls on the upside, and we're showing the call and the put both at that for the at the money. So we did that so because typically when you're trading, these are the out of the monies are getting quoted as well as the straddle or the at the money. So we just showed the puts on the downside and the calls on the upside and both at the money. If you want to see all the calls, you can click over here on the calls tab. All the puts will show you everything over here on the puts tab. We may even put something where we stack these together so you can see both of them together to see what ultimately what the straddles look like. And here's the straddles right now. We show the whole entire premium, but we're probably going to do at some point is split this bar so you see the coloring associated with each portion, both the call and the put. Okay, so that's the prices. So it's you can move the future, the vol, and the days and see how it affects premium. So now let's take a look at the Greeks. And I'm gonna and the Greek delta, call delta, put delta, that has the same model as the prices, calls, and puts. And we do that because obviously the deltas are going to change for each strike. The gamma, the vega, and the theta, they're the same regardless of it's a call or if it's a call or put. That those are generally associated for the most part with a single value for each strike. Now, some people will do a vol curve for the upside and a vol curve for the downside, so then those values will be a little bit different, but we do a single curve that represents both the calls and the puts on the downside and the calls and the puts on the upside, even though we're just looking at the out of the monies on both parts of the curve. So let's take a look. We'll go through the delta and the gamma and the vega and the theta so you can see, and then I'll leave it to you to play with this on your own. So let's see what happens. Let's move our futures back up to 59.5 and see what happens to our delta. So we increase our future. So what's going on? So we increased our future. So our put delta, which you would expect as we move away from a strike, our put delta is going to go down. And as we move toward or through a strike, we see our call delta went up. So that was that was sort of what, if you're familiar with options, that's what you sort of would expect. So now let's go the other direction. Let's go down to 57, and we're going to see that our put deltas are going to increase and our call deltas are going to go lower. So again, this is a really nice way to sort of validate or to learn about what's going to happen to the Greeks when these different movements happen in the underlying, in the volatility and the days to expiration. So let's take a look at the volatility. Let's bump this up. Let's just go right up to 25.5. See what happens to our Greeks. And we see that we don't have much happen over here with our at the money, but we see a little bit of an increase on all of these others. And I'm sure there's a little one there. We maybe can't see it as well. But actually, no, the color seems to be the same. So not much of a change there. So when the volatility goes up, the delta is telling you, well, all these have a little bit better chance of actually becoming in the money. So that's why our delta is increasing a little bit. So let's take a look and go down to 24, and we're going to see that we didn't do enough of a change, but let's go down to 23, and we're going to see that we get a little bit of a little change here, a little increase here, and little changes here on the calls going, so the delta gets lower and our delta gets lower on the puts side as well. So less volatility, less of a chance of movement into those strikes, more of a chance, that's why we saw a little bit of an increase here in the call, more of a chance to stick around where we are, okay? So that's what volatility does to affect the delta. And let's talk about this. Let's decay this down to 25 days to expiration, and we see a little bit, our deltas decreased here on the out of the monies and increased a little bit on the at the money, right? Because less days, no change in the future, a little bit more opportunity to stick around here and less of an opportunity to move out here. Now, if we really decay this even further, we're going to see we increased our call on the at the money, and it got decreases everywhere else. So again, you can do what you want in terms of moving things all over the place and see what happens to your delta. So it's a nice way to understand, if you own an options position, what's going to happen to those Greeks or to your position in general as things change in the underlying market. So let's jump past these two because these are just going to be showing everything. All the puts or all the calls, but I encourage you to just play with that on your own. And let's talk about this, what happens with gamma. So this is the change in delta as the underlying changes. So this is the second derivative. So it's a little bit more esoteric in terms of A lot of people don't, most people talk about prices in delta, but now gamma is what affects how your deltas change as the market changes. So let's just take a quick look at this. Let's move our future up to 59.5. Okay. And we see that our gamma's shifting. We moved up, so we move towards strikes. As you move towards strikes, your gamma is going to increase, and as you move away from strikes, your gamma is going to decrease. Okay, so that is something that you'll notice and you play around with as well, and you'll reinforce that as you have more experience with in the options market. And again, same thing. I went to the downside. Our gamma, as we move towards strikes, increases, and as we move away, it decreases. Okay, so I'm going to reset that. And now let's take a look at what our volatility does. Let's bump this up. So this one is also very good. Your vol goes up, your gamma goes down in these meteor strikes and up a little bit out here. Okay, so you see this change happen as well. So vol increases. It's almost like you're pushing down on the top of this, and it's giving some, it's given into some pressure here on the heavier part, and then it's pushing some of that what's underneath the middle part of the bell out to the wings. Okay, so really another good way of looking at this is just by playing around with it and seeing what happens as you make changes. Now I decrease the vol, and we have an increase in gamma. So again, similar to the delta, we had, you know, less volatility means we're going to stick around in a smaller range of price. So our gamma is going to increase a little bit, and we lose a little bit out here on the wings. Okay, and let's reset this and go with this. Now, what do you expect to happen here? So let's go forward in days. I expect that, yep, we get an increase, right? So as you move towards expiration, your gamma of your strikes around the money are going to increase, and those out of the money are going to decrease a little bit. Okay, and let's reset this, and the opposite should take place. If I push this up to like 40 days like it did for the other ones, we're going to see that our gamma decreases around this softer part of the bell curve, like the one with more, more stuff underneath it, and we push it out to these wings a little bit more. Okay, let's reset this. And very quickly, because this video is getting a little long, I want you to be able to get through it and not be overwhelmed. So we have our Vega. So let's just do this. Go up to 59.5 for our Vega, and we'll see what happens. So futures move. We're going to see some changes. We move away from strikes. We move toward. So we didn't see much of a magnitude change from an overall height, but we see the shift to the volatility, or the Vega gets pushed to the more into the strikes where we're moving toward, and less from and taking away from where we're moving away from that. Okay, so now let's move our futures the other way, and we should see the opposite effect. And here we go, same thing, more towards, less away. So again, things that you could play with and have a really good idea after you spend some time on here of what's happening with these different Greeks as the underlying market moves. So let's jump this guy up to 25.5, the volatility, and we're going to see that we get a little bit of an increase across the board in our Vega. And let's knock this back down to 23, and we should see the opposite effect. We get a little bit less everywhere. Okay, and resetting this, and let's take a look, and we move the days forward. Again, we should see decay, right? So as we move towards expiration, we're going to lose how much Vega we have. So that means you're going to, if you own options, you're going to lose some money, and if you have sold options, you're going to make some money. So that's something to keep in mind. And then if I go back up to 34 here, I'm going to see an increase in my Vega across the board. Okay, reset. And finally, we come to Theta. So we'll click on Theta. So now it's opposite, because when you have options, when you own, you lose. So this is a negative number. So it's going to say if you own options, you're going to pay decay. You're paying Theta. So this is how much you're losing by owning. But let's just do the same thing here. Let's move this to 59.5. We'll see what happens to this. So our futures move. We're going to see just sort of a shift in where the losses are going to, where the Theta gets bigger and where the Theta gets lower. Again, moving towards, we get a little bit bigger. Moving away, we get a little bit smaller. And if we bounce this guy back down to 57, same opposite, right? Move toward. We're going to get a little bit bigger and move away we're going to get a little bit smaller. Okay, so I'm going to reset this. And now I'm going to change my volatility to go up to 25.5. And I see my volatility shift here, and I see an increase in volatility is going to increase my theta. Okay, let's go back down, 23. A decrease in volatility is going to decrease my theta. And finally, we'll do our days to expiration. Now this one, can you guess what's going to happen? I go toward expiration, my theta is going to get larger, right? So if I move just time and not volatility or futures, I'm going to my decay, what I'm going to lose is going to increase as I move towards expiration. So something to really be cognizant of if you're long options. Okay, and finally, let's get this guy out to 40 days, and we're going to see that our decay goes down in our meteor section, and it goes up out here on our wings. So again, it's like we push down on the bell curve or up on the bell curve at this point and spread out some of the stuff that was underneath the main portion of the bell curve out to the wings here. So that is the QuikOptions education tool. I hope you enjoyed it. This is available out here as one of the individual apps that you can purchase from QuikStrike. If you have any questions, as always, please reach out to us at support@QuikStrike, QuikStrike.net, or support@bantix.com, and we'll be glad to help you out. Thanks for listening, and talk to you soon.